Welcome to Unstoppable Real Estate Investing Wealth. My name is Billy Alvaro, aka the Unstoppable BA, former billion-dollar mortgage banker, gone bankrupt, turned professional real estate investor. Where each week you'll learn the tools, strategies, systems, and secrets myself and other highly successful real estate investing entrepreneurs use to start, grow, and scale their businesses, creating massive profits, and how you can too. And we'll teach you how to put those profits to work so you no longer have to. Get ready to finally experience financial freedom and generational wealth. Now let's get started. What is going on, everybody? Welcome back to another episode of Unstoppable REI Wealth. I'm your host, the Unstoppable BA, Billy Alvaro, here to bring the heat with my guest today, Mr. Martin Saenz. Before we get into introducing Martin, if you're new to the show, this show is going to educate you on how to start, grow, and or scale your real estate investment business. We're going to give you the tools and tips and tricks, strategies and secrets that I use and all my guests use to really get them to where they are, where they were, to where they want to go. And today's special guest with Martin, he brings a unique spin to this whole thing, right? We speak a lot about marketing and sales and generate leads and growing your real estate portfolio and going out and, fixing and flipping and wholesaling. He brings a unique spin because he's on the other side of it where he's actually raising money for mortgage notes. So Martin, welcome to the show, brother. How you doing?
Good. Thanks for having me on, Billy.
You're in sunny Cancun today on vacation with the wife.
That's correct. All the way from sunny Sarasota.
I love it, man. So you're a Florida guy and you're in Cancun today hanging out. Well, I appreciate you taking time out to make the podcast. It's really cool that you didn't postpone it or reschedule.
No, not at all. Not at all. And we're talking about my favorite topic, mortgage note investing.
I love it. So what is mortgage note investing first and foremost?
Yeah, so it can mean a lot of different things to a lot of people because there's various strategies by which to go about it. But for the purposes of our hedge fund that I've operated for the past 9 years, what we do is we look for distressed mortgage pools. So these are mortgages where the payments haven't been made on the mortgages for 4 or 5 years. So we buy them in at a discount. Let's say they owe 100,000, the homeowner owes 100,000. We'll buy them in at a discount for 30, 40,000. And then we'll make a connection with the homeowner and work out a loan modification at par, which is 100,000. And so it's essentially this very similar process to a real estate flip, where you go in, you buy the home at a discounted price because it's in distress, and then you do XYZ to get it to after repair value. And we do the same thing on the mortgage side.
I love it. This is you. So you're not doing one-offs. You're actually going after pools of distressed mortgages.
That's correct. Yeah, we buy multi-million-dollar pools on an ongoing basis.
How long have you been doing this?
I've been landlording since 2009, which is about 13 years, and I've been doing mortgage note investing for 9 years, past 9 years.
So let's get into how did you get involved, started with mortgage note investing? Like, landlording to this, what was that like? What happened? How did it start?
Yeah, so it started out. I started out being broke. Like, how about that? Like, I'm laughing at your intro video because you're like, you mentioned a bankruptcy, and that's like, that is so brilliant to put it out there because none of us are perfect. Like, we all go through trials and things in our life. And so my wife and I were dead broke. We launched a federal government contracting company in 2005, selling goods and services to the federal government. And after 3 years of just being unbelievably broken in the hole, we started turning the corner, started making money. We started buying real estate properties, and we sold the government contracting company in 2013. And I was at a local RIA in the DC area at the time, and I ran into a note investor, and I'm like, wow, I can buy mortgages from Starbucks, with a cell phone and a laptop all over the country. And I can make contact with the homeowners and create these loan modifications. They create cash flow. And I was just hooked from that point.
I love it. So take us into you got started with that. I'm thinking in the beginning you started off with one-offs, buying individual notes, or did you go right into buying pools?
So my first purchase was a pool of 10 mortgages. They were senior mortgages in Ohio, and so I started out buying 10 mortgage notes. I had no experience buying. I had no business buying, and I got a very expensive education.
Usually that's what happens with all of us, right? We start with an idea. It's kind of get set, fire and then aim.
Yeah, yeah. But it was funny. Like there was one of the 10 where I actually got a loan modification, and that 10% of the pool was what motivated me to go on. And
That
and
one deal.
the one deal, what I learned from that is that there's two ways to go. There's two ways to exit in the mortgage note industry when you're buying distressed mortgages, and that is you exit through the property, where you take it back through foreclosure, deed in lieu, etc., or you exit through the homeowner. And I learned very early on that all I wanted, my sole focus, was to keep the homeowner in their home while creating a long-term cash flow stream for myself.
Smart. Smart, man. So tell us then, what is your methodology, your process, your strategy for buying these notes? Because you came in the beginning, you made some mistakes. You probably didn't know how the hell to analyze these things, like what to look for. So when you're doing this strategically as a business as big as you are, what do you look for in a pool in order to in order for you to know that A, this is going to be a good investment, and B, like how do you even figure out what to bid on that pool? Like what's your analysis look like?
Yeah, so I'll start with what I didn't do initially, because I think that will be helpful
Yeah.
for those that may look to do this for themselves, and that is I came into mortgage note investing with the eyes of a real estate investor, a landlord. So my whole focus on the due diligence process was on the property itself, which is the underlying collateral. And that was the huge mistake, because you get what you focus on. So if you focus on the property and buy based on the property with no thought on the homeowner and their ability to pay you every month, then you're going to get what you get, which is the property. So it was when I started incorporating the analysis with the homeowner, doing credit report analysis, skip tracing, bankruptcy searches, and I started delving into the homeowner to determine who the homeowner is and their ability to pay me
Right.
if I purchase this asset, and also what the underlying collateral is in the case I do have to foreclose.
All right. So I get that if you're doing one-offs, but if you're buying a pool, let's just call it $10 million of distressed mortgage notes, how do you go about as a business to do that on a bundle of mortgages at one time? Because you're looking at two different pieces on multiple, you could have 100, 200, 400 different mortgages and notes that are attached to a property. How do you do that at scale and quickly to identify, what the property is, what the underlying asset is, and then more importantly about the individual themselves? What does that look like?
It looks like a very grueling acquisition process, which it is. So a lot of companies at our level uh, of purchase, they will do like spot checking, make assumptions, and you know build pricing matrices based on percentage that's going to fall out, and all of that. We don't do that. We actually do an assembly line operation where we analyze each individual mortgage. We're pulling title reports, so we're understanding lien validity, lien positioning. We're doing fair market value analysis, where we're using certain various data points and triangulating those numbers. Doing credit report analysis on each loan, as well as skip tracing, bankruptcy searches, and then we compile all this data and then into our pricing matrix to go and price out pools and mortgages. And we have a 20-person operation, so we have an acquisition team that that we kick into place every time we have a pool of mortgages we're purchasing.
So you got this thing down to a science. You systematize the shit out of it.
Yeah, everything is, yeah, everything is. There's policies and procedures for every step of the process.
Give me an idea, Martin, of how many mortgages do you have right now that you're servicing or that you're attempting to service that are under management?
Yeah,
Value.
we have about so there's my partner and I, we own privately without any investor capital. We own about $30 million worth of mortgages, um, which is about 1,200 mortgages, and then we also own about $100 million in unsecured debt that was formerly secured with real estate, and so that's, and then we also own an we run and manage an income fund called Bequest Funds that we take on. It's a 506c Reg D income fund where we take on investor capital and pay a monthly return to our investors.
Got it. And I want to get into that in a second. I just want to dive a little bit deeper on the note side. So a part of your due diligence, you're buying these things, I'm assuming nationally, you get a pool. Are they all commingled into one state? Is it spread about multiple states? What does that look like when you're making your bids?
Yeah, we buy in all the states, and when you receive a pool of mortgages, it's always, spread out throughout the United States, and you want to diversify yourself that way anyway. So we buy in all states at the end of the day. It doesn't matter to us, because once you have your process of asset management workout, it doesn't matter if you're feeding in a mortgage that's in a judicial state where it's going to take you a few years to go through the workout process with the homeowner, or it takes you 2 months, like in the state of Georgia, that's non-judicial. It doesn't matter, because there's constantly mortgages at every phase of the cycle at any given time. So
yeah, that was going to be my question. Like, I know where I originate from, New York, and now I'm in New Jersey. Those judicial states, in some cases, you can be tied up in court for 7, 8, 10 years in the foreclosure process. So you'll still bid on those types of mortgages, on those notes, rather, those defaulted notes?
Absolutely. We have incredible workouts that occur because the balances are so large, and so yeah, New York's a great state, and also too, it's just it matters who you're aligned with legally, like who your attorney is, and how good and
Oh, yeah.
competent they are to run through the foreclosure process with the mortgage note.
Yeah, for sure. The attorneys can screw things up more ways than one.
Oh, absolutely, yeah, yeah.
So when you're going through, Martin, and you're analyzing this, tell us how on your portfolio, not the ones through Bequest, but the ones that you're buying, how do you go about figuring out what your bid price is going to be for that based on individual mortgages that are in one huge pool nationally? You have judicial, non-judicial, different phases of the foreclosure process. So what does that look like?
It it's really based on the relationships and the past purchase pricing that we've negotiated with other sellers. So we we have we're very similar in the mortgage note side of things than to the real estate side. In other words, like, there's no retail space right now in the mortgage note industry. It's all dead for the most part because the inventory's dried up. So
Yeah.
same thing, like on the unless you're getting pocket listings or whatever. I mean, you can only fish through MLS so much, to get some good deals. So there's not much. So the real deal flow in our industry is between funds that are already in place, where we all know each other. It's a very tight knit community, and we've traded to the tune of millions of dollars with these trading partners over the course of years. And so we already know pricing expectations. We have a sense of that. And in some cases, we've already pre-negotiated from a prior trade, and that pricing model will carry over into the new trade.
Love it. I love it. It's a whole nother world. What so when you're buying, let's flip over now to to the bequest funds, right? So you're raising capital in your fund that you're putting out there. What does that look like? What does an investor, what kind of returns could an investor expect in those types of funds?
Yeah. Bequest Funds is a $50 million income fund that we launched about 2.5 years ago. There's currently about $20 million assets under management, and and what we look for is really the type of investor. We want to have good alignment, similar mindset to the investors that we bring in. So we're all about monthly income. We're all, especially in these inflationary times. I mean, that's the best hedge against inflation. Put more money in your pocket every month.
Mm-hmm.
And we're all about the legacy play. And I heard legacy. I heard that in your intro as well. So I believe you're in alignment that way. And so we're about an evergreen income fund where you place one simple investment and you receive monthly income for life at a 9% annual return paid to the investor on a monthly basis. And that's
Is
what
it a
it's
pay down of principal and interest or just interest? What does that look like?
it's just interest.
Just
So
interest.
there's no return of capital until redemption occurs.
Got it. How risky is this type of investing for an investor?
So Bequest funds, the income fund, only buys seasoned performing mortgages from the secondary mortgage market.
Okay, so this is a performing note fund, not a non-performing note fund.
Correct. It's a performing note fund. So what happens is in the secondary mortgage market, you have similar funds like our private fund I mentioned that buys distressed mortgages, and we modify those mortgages and we re-season them over the course of 12 months, 24 months. Again, these are good homeowners that just ran into a hiccup,
Yep.
a divorce, lost a job, health issue, and they originally got a loan at Wells Fargo, PNC, Deutsche Bank. This is who underwrites the paper we buy, and they go through Fannie and Freddie underwriting guidelines. They meet the DTI, they meet all the other requirements. They just ran into a life circumstance, and they stop paying. We've all been there, and
Yep.
and so, but then now they found love again. They found a job, and they got their health back, and they just need someone to go and not strong arm them, someone to be compassionate, to find out what they can afford now. We bought the mortgage at a discount, so we can make concessions. We can work to meet with them for a win-win situation. And there's other companies that do this, have a similar business model. And once that mortgage gets remodified and seasoned again, Bequest income funds will buy it into the income fund at an 11 to 12% yield, by which we're able to pay out our 9% to our investors, even
Yeah.
though the coupon rate is in the single digit.
That was going to be my question. So because you're buying it at such a discount, you're able to buy it at a number where you're able to pay these investors 9%. Your coupon to the back end homeowner might be, let's just call it 4 or 5, but because of that discount you're buying it at, you're able to pay the 9, and you're still making the delta of 2-3% on top of that.
Yes, and there's something even more. There's something even beyond that, and it's our secret sauce, if you will, right? Like, that's kind of cheesy to say that, but I said it. It's our when you buy in at an 11-12% yield and the coupon rates in the single digits, it lowers your investment to value percentage. So our investment to value percentage is at 58%. So we always maintain as a portfolio collectively below 65%. So that's equity coverage.
Oh,
So
yeah.
in other words, if we buy a home worth 200,000, I don't know if there's any $200,000 homes in the market now, but we're not going to be in that deal for any more than 130K. And
Smart.
so if we have to foreclose, we'll get our money back.
That's smart.
But if we get paid off, we'll get paid off at par.
That's a great model, dude. Like a really good model.
Thank you.
Yeah.
Thank you. Yeah, we think it's, I mean, I'm the largest investor in the fund. So we started this fund. It was really for my partner and I and our families and friends, and we believe in this. We believe in what we're doing is good for society, and we believe it's good for the investor.
It's good for everybody around. I like the fact that you're not one of these investors that's just cutthroat. You buy the mortgages, buy the notes, and you're just like looking to kick the people out. I mean, it says a lot about your personality and about your value system. And I think that in and of itself is going to propel your success to the next level because you have a conscious level of how you're dealing with people, and that it speaks volumes of a person when they do that.
Ah, thank you.
Yeah.
Now, I think I was thinking about it like I don't know, probably a year ago, and I think what's interesting is in 2006 when my wife and I bought our house and we got behind on our mortgage because we just couldn't pay anyone, and and the lender treated us like garbage. I mean, we got a new person every time we called. They rejected us for loan modification requests. I mean, they're always missing documents that I sent in, like everything. And it got me so frustrated and stressed. At the time we started making money, I just cut a check and paid them off in full. And that felt very liberating. But I think that always kind of stuck with me. I'm like, people shouldn't be treated like garbage. I mean,
Yeah. Just a
we
number in the
raise
line.
our families and stuff.
We've been there. I was there too, man. 2006, 8, 9. I mean, I was in a world of shit, and the same thing. They don't care. They don't come from a conscious level of caring. Martin, tell me how you go about raising capital. What's your process for going out and actually getting investors to put money into your pool? Because you did start by saying you're the largest investor, you and your partner, but I'm sure you have a $50 million fund. I don't know if it's open-ended, so it's constantly. Yeah. So how do you go about marketing, right, to bring in money into that fund? Talk about that.
Yeah. So, I'll say this, like every, I've done it all in the mortgage note industry. Like I don't know everything whatsoever. I'm not going to say that, but I've done all the roles, if you will. I've sourced deals. I've done the underwriting. I've done the workouts, loan modifications, portfolio management, and raising capital is its own unique animal. and
Yeah.
and I've had to learn it, and it's like it's like joining the Marine Corps. I mean, you're going through boot camp. You have to build a whole marketing engine. We have a marketing director, we have a investor relations VP, and essentially, lead generation. That's its own, like, my goodness. I mean,
It's on out.
yeah, we want to get the right people. We don't want someone just because they have money. Because if you take their money and they're going to give you a hard time, I mean, who needs that?
Correct.
So you want the right type of person that wants to build legacy wealth, something they can pass down to their kids or whomever, and you want people that want more in life and that are kind of striving like you're striving. And to find those people is tough. But I'll say, like, word of mouth has been good. I've written a few books on mortgage note investing. So a lot of the investors in the fund, we have about 70 people in the fund. A lot of them read my book
Yeah.
on Amazon, and then they'll reach out. And what they find is they don't want to build a note business for themselves, because I know I just gave you like the pretty version, like, oh, you're modifying notes at par, blah blah blah. But there's compliance, there's regulation.
Oh yeah.
There's every state has its new.
Yeah.
There's it's a tough nut. It's a tough nut. And then so people were like, look, I just want monthly income. I don't want all the nonsense. So I think the book has done great to bring people in, as
It's
well as
smart.
podcasts like this.
Yeah, it's smart. Writing a book, you're automatically perceived as the expert, and people are going to read it, and then they're going to come to you if they want to invest. And look, everybody in the beginning wants to, I'm going to go out there and start a note investing business. But when you get down to it, it's a business in and of itself, and it takes a lot of time, energy, and money in order to get that business started and then eventually launched. And I'm of the mindset where I know my lane, I know what I'm good at. If I have extra dollars, 100 here, 200 there, I'm investing it not only in my own business, but in other people's businesses to diversify, all generally real estate related. But investing in other experts is the name of the game. like you, I have a ton of people that invest with me in the commercial end with the apartments that we do, and the single family fix and flip, the single family buy and hold. We pay 8 to 10% coupon, and a lot of them want to be in real estate investing, but when they get down to it, doctors, financial planners, dentists, they don't have the time necessary to go out there and become the expert in that field. So they rather just take the money and put it with an expert like us to put that money to work. So one day, they don't have to work as hard as they are.
No, that's great. And I bet we can swap a lot of stories on capital raise. We get a lot of people that are they're in Wall Street and they've been burnt out and they're stressed because they're constantly looking at their phone to see what their portfolio is doing. They're constantly worried because this news report, this consumer sentiment came out, CPIs at here, and so they live with a constant burden of stress with investing. And investing should not be stressful if done correctly. So they get to us and they're like, I can just set it and not have to ever think about it and get a monthly.
Not have to worry about the ups and downs, roller coaster ride of what's going on. Listen, this is a good segue into my next question. When I read over your bio, I was, looking at one of the questions is how do you handle economic downturns? And right now, we're at a shifting point in what's been, for the last 2.5 years, a really killer market. I know we can't do market predictions because nobody has a magic ball to predict, but what are you sensing? Because you're buying nationally, right? So what are you sensing on your end? And is this economic downturn going to be good for your business? And if so, why?
Yeah. So I follow certain economists that are not on the major cable news networks. And what I find with these individuals is I find I have some level of predictability in terms of where things go. I feel very confident in where we're headed. And I'll give you some of the names. Lynn Alden, Joe Brown from Heresy Financial, Peter Schiff, the gold bug guy, and a few others. And we're headed towards a major recession, in my opinion.
I agree.
And it's going to create an abundance of inventory, an abundance of opportunity. And so people should just be gearing up for it. And I also think there's going to be a shift of wealth to Bitcoin. I'm a Bitcoiner. I buy Bitcoin every day, actually. And so I'm a big believer in the death of the fiat currency from a global perspective, and more governments shifting to have a Bitcoin backing their currency and also gold backing their currency.
Yeah.
So I think we're headed towards a major recession.
And with that major recession, that's going to be a real good thing for the business that you and I are in, I'm assuming, correct?
Yeah. I mean, 100%. There's going to be more product. There's going to be more inventory, that's going to come. There's going to be more regulation as a result too. But what's very scary is the empowerment that our current administration is wielding and I predict there's going to be another CARES Act. There's going to be more of those because I think we kind of set the stage where landlords are going to be forced to defer payments, where mortgage companies are going to be forced this way, and I think that's coming because that's a popular thing, and it's there's a segment of the voter community that likes that.
Yeah, it's insane on how they hurt those that try to better the economy, and it's just overall it's just hurting us. It's not helping, it's hurting.
Yeah. I mean, like you go and defer payment, and then what happens when the moratorium expires? The landlord, he's got to eat or she's got to eat. She's got a debt burden to pay every month too, and so and then some of those mom and pops, they start putting their house and properties up for sale because they're done with it, and so there's less appetite for investors to want to take that risk. But if they take that risk, they're going to increase rents accordingly to accommodate the new risk that's on the table, which is going to cost more for the consumer. So all this is snowballing to hell.
It always, and that's what they just don't get. It always freaking costs the consumer more money in the end.
Mm-hmm.
They think they're helping and they're freaking hurting them.
Yeah. Yeah.
What are you doing, Martin? Because I know I'm with you. I think the recession is looming. I think it's going to be, it's going to hurt the economy. There's going to be a lot of opportunity. What are you doing to prepare for that with your business, as far as raising money, and just your overall business strategy right now?
Yeah. So, I always kind of, and I talk to investors daily because I'm always, on the grind raising capital. And I get asked this all the time, what's the risk here with your fund? Because you don't know what you don't know, and people don't know enough about the industry to really assess the risk factors. And I say, look, there's three risks in any type of investment. Forget just our fund. It's every. These are three maxims you should look at. One is who's the operator.
Yep.
What's their experience. Do they have any civil lawsuits against them? What's their background, that kind of thing, and what kind of team do they have in place. And then the second thing is what's the cap from a capital preservation perspective. How are they protecting my capital? So in our case, the equity coverage, that 58% investment to value, that's critical because we show that we're going to preserve your capital. And the next thing is, how are we going to produce cash flow from the assets? Because if you're not producing cash flow from the assets, you're going to produce it from new capital raised, which is called a Ponzi scheme.
Yeah.
And so you have to show that you're buying assets that are going to cover the monthly nut to the investors. And so that's very significant. So we have a chart where we show each month what we took in total income versus what we paid out in monthly distributions to show that we are covering that nut.
Yeah, to completely eliminate the objection that, are you a Ponzi scheme?
Yeah, so I think that operators like us, we're going to have become more popular. I think there's just got to be, because I mean, who can trust Wall Street, the federal government, the Federal Reserve? I mean, who has trust in those entities? I don't. I don't know.
Yeah, I don't know either. Martin, this was great, brother. What are the name of your books that we can point people to?
Yeah, my first one, Note Investing Made Easier, Note Investing Fundamentals, and Cash Flow Dojo.
Well, I like that. Are you a karate guy?
No, but I did it as a form of discipline.
Absolutely.
Kind of protecting your dojo, if you will.
I love it, bro. Look, Martin, this was great. Definitely stay in touch. I'll shoot you my my cell phone after this. I have yours.
Awesome.
Phenomenal. If people want to find out about you and your fund, where do they go?
Yeah, they go to bqfunds.com. That's bqfunds.com.
Beautiful, brother. Really good chat with you. I appreciate you taking time out on vacation in sunny Cancun.
Yeah.
Enjoy.
Thanks, Billy.